Yeah. Well, I guess we're on the air. So it is February 6th, 2026. It's a Friday. Friday fun day with Bob Morris, Robert Marson, and your host. That's me, Nadine Turman for Wall Street Beats, powered by Passes. And we're on the broadcast. And today it sounds like we're going to have a very focused conversation initially on energy. So, Robert, why don't you kick it off?
Absolutely. So today, normally I'm talking about nano cap stocks that I think
Yeah.
have 5 or 10x positions, and when I'm wrong, they can go to zero. So that's my normal life. But today, it's a step back from the excitement of Russell 2000 nano caps, and I'm going to give an update on half of my MLP portfolio. So I
Okay.
I own four, two oily and two gassy. I guess if
Okay.
you I guess if you called management either one of those, it wouldn't be a compliment, right? anyway, anyway, I thought it was funny.
That Friday humor, I'm
Anyway,
not ready. I haven't finished this, so I'm not ready for that humor yet.
Friday dad humor. I thought it was funny.
Okay,
Anyway,
that's good.
today is the two oily stocks: Plains All America and Marathon (MPLX). It's Marathon's midstream
Oh,
business, and these basically are pipeline companies. And these two focus more on oil and natural gas. And because of that, um, psychologically, everybody sort of neglected them in the last couple of years.
uh-huh.
Everybody knows that there's this big demand for electricity, power, and to satisfy growing AI and data center build outs. And everybody knows that those companies, have unit growth opportunities, while most people believe so. They're the sexy stories in the oil patch for the pipeline companies. You want natural gas exposure, particularly U.S. dry gas. So energy products and energy transfer
Right.
have gassier business lines, and they are and what the company is doing is if you're oily, you're not really investing as aggressively for growth in oil. They are trying to build their natural gas sides, but there's only so much you can do. Both of these
Yeah.
companies, MPLX and PAA. So they're trying, but they're still dominated by oil related businesses, and those are not sexy now. There's no unit growth there really, but because of this, the companies have been much more generous with their payout ratios and their
Uh-huh.
dividend. And because of that, the stocks have been far better. Because what I get with MPLX and PAA is 10, 12%, 15% dividend growth, distribution
Yeah.
growth, to be correct. So they started with higher yields. And to begin with, in the last year, probably 8 to 9%, they grew them double digits, and the stocks now are at all time highs basically. So they've been actually good stocks compared to the
Yeah.
MLP, the narrow MLP universe. The
Yeah.
natural gas heavy guys,
And by the
you
way,
know,
I listened to you and I bought Energy Transfer. So thank you for that idea. I will admit I liked your idea and I did it. So there you go.
Energy transfer is far sexier than Plains All America, but they're investing heavily for the growth. The growth is
Yeah.
still ahead of us, so we haven't seen it yet in any material because it takes 2, 3 years for a lot of these projects to develop. But they're only growing their dividend 3, 4%. So they have lower yields to start, 6.5 to 7.5%, and they're only growing 3 or 4%. Now, energy transfer did something smart. They said that they were going to, not grow this year, but next year would grow double digits organically, and then there could
Yeah.
be accretive. It could be accretive if they did deals. So they got people excited about next year. I'm not going to focus on them. I'm going to do that company next week. But as far as Marathon had solid results, solid EBITDA growth. They have a suite of growth projects that they think is really exciting, and I agree with them. They think they could keep growing their EBITDA mid single digits, um, mid to maybe high single digits if they add some bolt-ons, and they raised their dividend 12% this year. It's still I think it's still a 7.5% yield now, give or take, and I think it's going to grow 12% for 2 more years. They said, Now they've taken their payout ratio up quite a bit. So at some
Okay.
point, you can only turn 6% growth into 12% dividend growth for a couple more years. But again, this is a 4 to 5 year old position for me. I'm in
Yeah.
it around. I'm in it around $20. It's 56, and next year I calculated the dividend could be close to $5. So, or maybe 2 years from now. So I can have a
Okay.
25% cash on cash return yield.
Yeah.
And I would still buy Marathon on MPLX on any dips. Planes is the same thing with the dividend growth PAA. I'm in that in the low in around 11 or 12, 11 to 12, and their dividend has been growing, very strongly as they said they would do 3 or 4 years ago. And right now, the dividend is up to $1.60. I think it's $1.67 right now. And
Okay.
we were buying this stock. I've talked about this stock all
Yeah.
probably at least a year and a half, and it ranged from 15 and change to 20. At 20, I wasn't pounding the table, but at 17 and 16 and change, where it was a couple of months ago, with that dividend being a dollar, 71, going up 15 cents for 2 more years. So it'll be
Yeah.
in 2 years, in 2028, it'll be, and it's 2 years sounds like a lot to stock investors, but it
Yeah.
really is.
These days, right?
Yeah,
These
yeah.
days, that's forever.
But you have to, again, and when I bought this, I want to say the dividend was 80 cents. Okay. And I paid 11 for it, right? And they had said they were going to grow the dividend to restore it to the prior levels in 3 years and then grow after that. And that's what they've done over 5 years.
Yeah.
So I didn't have a huge dividend yield when I bought this. I was buying their plan to restore the dividend to pre cut levels from the COVID oil crash, and they did it and then some. The dividend's probably going to be back to an all-time high. So,
Yeah.
again, I believe these stocks should be trading at 6 to 7% dividend yields. The the oily pipeline companies that are MLPs. So I still think they have upside to them, but maybe another 10% upside plus the dividend if the Fed starts if a new Fed head starts cutting rates when the old Fed
Yeah.
head gets removed. So I still like them, but I'm not pounding the table buys up here. They've had nice runs. They've both had
Yeah.
real nice dividend increases. So if the stock market gets worried about oil prices and they dip 5 to 10%, I'd be delighted to add to my positions. That's
All right.
MPLX and PAA.
Well, that's what I was going to ask you is that, like, is there anything somebody can do today? Let's say they didn't follow you into these before, they haven't made that money. What do they do?
No, if you need yield and you're going to buy
Yeah.
something, right? I
Yeah.
would buy Plains All America for sure. The dividend's still
All right.
high. Next year's increase will get you 9.35% right now, and
All right.
that'll happen in less than a year. So yeah, I would buy a fractional position, a third,
Okay.
a half, 2/3 of PAA if you had the requirement for a high dividend yield in a stock, for sure.
Okay. All right. Thank you.
You're
And
welcome.
Bob, Mr. Energy, Mr. Wall Street Beats Energy, what is on your mind today other than
No,
what's going on? Like, are
yeah,
we going
no,
to have a geopolitical issue today or not? What's going on? What kind of tensions around the world are making oil up or down?
yeah. Before I jump into that, I just want to follow up with Robert. I agree with him on his stocks here.
Okay.
Although I do not own Marathon, I do own Energy Transfer for the reasons that Robert laid out. But on the midstream, I own four names. The biggest position is Williams, and
Okay.
Williams did just raise their dividend by 5% a week and a half ago. They will report fourth quarter earnings next Tuesday, and also have an analyst day on Tuesday.
Okay.
So that's a name that I'm overweight. It's my biggest midstream position, and I do like him. I do expect that we'll hear good things out of the analyst day next Tuesday. So continue to be overweight Williams. The other three names I own, next biggest position is Kinder Morgan, then ET, and then Enbridge. And again,
Okay.
all those on dividend yield. It's not as big dividend yield as Plains All American, as Robert pointed out, but those are the names that I do like on the same thesis or argument that Robert laid out on the midstream names. But then,
Bob, can I interrupt you for 1 second? So let's say
sure.
somebody hasn't had a position, they hear that you have a lot in Williams, but you're going into an event next week, but you seem pretty confident about that event because that sometimes for people either is a little bit too risky. It's kind of open the envelope, or do you think like no, it's not an open the envelope risk that you're okay if you don't have a position, you could buy before then?
I mean, I'm okay buying it before then. I don't expect any disaster. I don't expect any negative
Okay.
news. The downside is just a turn down in the entire market. And
Right.
energy's up across the board here again today.
Yeah.
So, the reason energy's up across the board are oil prices are continuing to hold in very nicely here. When I say nicely, we're at around $63 a barrel, which, you know, historically over the past year, people may not have jumped up and down about, but relative to where expectations were throughout most of last year, and where we've been recently with a lot of people thinking that oil was going to dip to 55 or $50 a barrel, $63 a barrel is a nice price for these companies. And so far, earnings have been on the positive side. And we've talked about some of those last week, although the bulk of the earnings for the E&P sector are still ahead of us. But the thing that continues to move oil prices, as we talked about almost every time we're on the show, are headlines. And as you pointed out,
Yeah.
Nadine, the headlines we're going to get later today are what's going to come out of this meeting with Iran in Oman.
Right.
And I really don't think we're going to get a lot concrete out of it. I mean, there are some differences on what the U.S. wants to negotiate and talk about, and what Iran wants to stick to and talking about in these negotiations. And what's interesting is I don't know if people know, but the negotiations are in Oman, but the U.S. representatives, Kushner and I forget, our in our other representative are in one
Yeah.
room,
Yeah.
and Iran's representative is in another room, and the Oman representatives are going back and forth telling them what the other guy said. So they're not even
Yeah.
in the
Yeah.
same
Right.
room, sitting
Right.
facing each other. They're in different rooms with an intermediary shuffling back and forth, telling them what the other guy's saying and what they want to talk about and negotiate and so forth. So, I think the best outcome would be that they agree to continue the talks and keep the channels of communication open and avoid anything that might result in some sort of military conflict as the U.S. continues to build up their military presence in the Gulf over there. So we'll see what comes out of it. It's hard to predict how oil prices might react to any outcome other than if it's just a complete disaster and they walk out and say, look,
Yeah.
we can't agree on anything. And the U.S. says, well, light the missiles, then that's obviously the worst case scenario, but not something I expect. So the end of the day is probably going to keep tensions going because there's not going to be any clear
Okay.
answer. There's not going to be any clear resolution. There's still going to be that risk that if there's no agreement, the U.S. may take military action. I think the Trump
Yeah.
administration would like to declare victory and say, oh, it was positive. We made some progress and we're kind of, stepping down on the military rhetoric or threats of military intervention. But
Yeah.
oil prices, I think, will continue to be on edge here.
Okay.
So, given that and given this rotation we've seen in the market, energy continues to perform extremely well here so far in 2026. So I'm not changing anything, not moving any positions around. Although, following our discussion on Tuesday, I did buy a little bit of Devon, and I said then that if you didn't own anything, if you weren't overweight, didn't own energy, I would buy Devon that day, just given their merger with Coterra Energy. On the
Okay.
natural gas side, interestingly, natural gas prices have come back as we expected they would because we got past the extreme cold weather, but they're still holding in nicely at 350. It's a good price. It's not a great price, but it's a good price. Yesterday, following on all this cold weather we had the prior week, we had the largest natural gas storage withdrawal on record, although it
Yeah.
was a little bit less than what market expectations were. So, in natural gas storage levels are still above a year ago. And given all that and the fact that we're going to see milder
Yeah.
weather going forward, and we're 2 months away from the shoulder period, nat gas is around 350. So, I still like Expand Energy and EQT. They're going to report next week, but we're not doing anything. Actually, they're going to report the following week in 2 weeks. Just holding on to our positions there, and not, we're happy with where we are here, and nat gas. Nothing unexpected is
Okay.
occurring here. otherwise. So, in the past week, the only thing I did was add a little bit of debit, not selling, definitely not selling anything, and keeping an eye on the headlines with what comes out of Oman on the Iran negotiations as far as how that might impact oil prices here.
I got a question for you, Bob.
Yes, sir.
So oil prices are very relevant to these stocks, and I know it's impossible. And I myself say nobody can predict the price of oil. Period.
Mm-hmm.
Okay,
Yep.
there's a strip out there, so if things don't change, you know what the market
Mm.
thinks. So
Yep.
higher or lower, obviously, in the future on today's pricing, but nobody can predict where the spot's going to be in 3 months or 30 months.
Yep.
So, what do you have in your mind a good range of oil that you would expect would fit this year with the slight oversupply, sort of being the bear case, and obviously geopolitical disaster being the bull case? Do you think a range of 60 to 70 or 60 to 80 or 55 to 75? I'm letting you give me a range that's pretty wide. So,
Yeah.
Yeah.
I mean, the worst case scenario is 55. If all of a sudden, peace breaks out in the world and, we reach some sort of an agreement with Iran and maybe lift some of the sanctions. A peace deal is reached between Russia and Ukraine. We lift sanctions. Things move very quickly in Venezuela, and that oil production begins to ramp up. I mean, the downside case is $55 a barrel, probably. And if you get all those, if peace breaks out and the global economy collapses, well, then you could go to 50. But I think that's sort of the black swan scenario. The upside is 70. If tensions continue to percolate with Iran, if there's any supply disruption anywhere, if we continue to press hard on sanctions with Russia, and India agrees, as they have, to not buy oil from Russia, and the economy remains strong, and the upside is probably 70. So, I know that's a wide range. I've said I think we stick around here around 60. The volatility in oil prices have been extremely low. I think the 25-year average is 60. So we're right there
Right.
at that point. So that's sort of where I would, on the energy stocks. Obviously, if you went to 50 to 55, that's not positive for the energy stocks, but that's not our base case scenario. I think our more
Okay.
likely scenario, or our more likely scenario, is 60 to 65.
you want to venture a riskier call, even natural gas?
Go for it, Bob.
Natural gas. We're past the midpoint of winter. We know we've probably seen the worst of the weather.
Yeah.
Natural gas storage levels are still above a year ago. So I think natural gas for most of this year through the summer, we're probably $3.50 to $4.
Right.
You know,
That's
we've got
where the strip is for the rest of the year. It was 380
Yeah.
or 375.
Yeah.
yeah, and
All right.
we've got to get some sort of strong move or deviation from the mean on weather or some other factor that sort of drives it apart from that. And then we come out of the winter, the track we're on that right now, storage levels will likely be a little bit higher than they were a year ago coming out of the winter.
Yeah.
Then we see what the weather is in the summer, and then we're back to figuring out where we're going to be going into next winter and what next winter weather is going to be. But in the meantime, the upside is that you've got this continued data center build out toward the latter part of this year. You've got more LNG exports coming. So, structurally from a supply demand balance, that's all positive. But the storage situation is what sort of keeps us, I think, in that $3.50 to $4 range here, apart from some unexpected extreme weather again.
So, gentlemen, so on that note, right, because we're kind of talking 2026 here, but you guys have given some good thoughts about yield, the dividend yields, and the strength in that, and what people are doing. But at the same time, cautioning that the price of the commodity matters. For someone who is thinking longer term, right? Do they have to be trading these things more, or can this be part of a buy and hold portfolio? Any of
No, I
these
think
names?
I think a lot of these things are buy and hold because they are dividend stocks. They are basically what we talked about, what I wrote about 10 years ago, that the industry has turned into, these are energy utilities. These E&P names are energy utilities. They're not looking at growing production. They're looking at maintaining production and returning capital to shareholders, which they've been very successful with focusing on over the past 5+ years. That will continue to be the case. And with the commodity, mostly the better stocks are up over the past year, despite oil prices being down over the past year. And that's because you've seen margin expansion. At a constant oil price, you've seen margin expansion with cost reductions. And what we talked about Tuesday, something you will continue to see, is this is an industry that benefits hugely from AI. This is a very data heavy industry. With the drilling data, with all the geologic data they collect, AI will have a big impact on continuing to improve those margins for this sector. And so far, every company's really leaned into talking about AI and the benefits of AI in their operations here when they've reported earnings. So this is a sector that benefits heavily from AI, a sector I think you'll continue to see margin improvement going forward. And the other thing you'll see is continued consolidation. One of the reasons we like Devon is that that consolidation provides huge synergies, huge benefits. And at this point, we've got a very short list now of names left that might be involved in consolidation. You've seen massive consolidation over the past few years in this sector, and that's been a huge benefit.
And I asked that because I actually saw a really interesting. This is an interesting point you made about AI. That there was a research group that listed out. Um, they looked through a lot of data globally to find out who in each sector that wasn't an AI tech company or a hyperscaler was using AI to improve either costs, labor, so instead of just like cutting costs, like labor efficiency, if you want to call it, or affecting growth. And then they weighted it heavily if you could get a bonus for all three, right? And so I'll send you the list of names. It might be interesting for you to take a look at globally. But as an investor, how soon should we be able to um, see that in these businesses? Because some of it might just be running their business. It could be from exploration. There's like different ways that they might be using it in the energy complex. But as an investor, how do you look into that? How do you research it to pick the right names and or keep track to see who's using it to create a better business or moat or however you want to call it?
Yeah, so you're seeing it real time today across the industry. I mean, in the time it takes to drill wells, in the placement of the well bores when they drill these 3 mile horizontal wells, where you're probably seeing the bigger benefit is the bigger companies. The Chevrons, the Devons, the Exxons, the EOGs. Those are the names that have the scale, that have the massive amount of data, that have massive operations that collectively will benefit the most probably from AI.
Okay. But but how does somebody look into this and see who's doing it and not, right? How do you differentiate?
It's hard. Everybody talks about it. Everybody's saying they're
Yeah.
doing it. And there's a little bit of shared data across the industry because
Okay.
in drilling wells, you use service companies, you use Baker
Okay.
Hughes, you use Schlumberger, and you know, yes, there's some proprietary data to some extent, but the data gets out. And everybody, remember, this is an industry where in a lot of these wells, everybody has shares interest. So, Chevron's drilling a well, they may own 75%, but Devon may own 25%. So they see
Mhm.
all the data as it occurs.
Okay.
So the data is sort of a data shared industry to a very large extent. So it's hard
Okay.
to you really can't look at it and say, oh,
I
geez,
froze.
Chevron's doing a lot better than Exxon with
Hello.
AI. You're just not going to be able to determine that.
Yeah, and I asked that because maybe the answer is going to be you'll see it with multiple expansion because all the rising tide lifts all boats, right? If the whole industry improves in some way. But I was just trying to get at like how do you pick the winners in there? But maybe your point is that that's just going to improve the industry.
It's going to improve the industry, and then it comes down to who's then got the better assets.
Okay. All right. Well, great. Thank you. Thank you again. It is Friday Fun Day here
Mhm.
at Wall Street Beats, powered by Passes. Thank you, Bob. Thank you, Robert. It's Nadine here. We appreciate your time and your support, and we will catch you back on Monday. Thank you so much.
Thank you.
Thank you.
Bye, guys.
Bye.